This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Growth in global oil demand is set to grind to a halt in the fourth quarter of this year as an economic slowdown deepens, the International Energy Agency, IEA, said on Wednesday, but said it would resume strongly in 2023. The outlook preserves a relatively bullish view for robust growth next year despite economic headwinds, built on the expectation that China's COVID lockdowns will ease while growth in air travel will boost jet fuel demand. Global oil demand remains under pressure from the faltering Chinese economy and an ongoing slowdown in OECD economies, the Paris-based energy watchdog said in its monthly oil report.
Oil prices edged lower on Wednesday on demand concerns raised by the prospect of further increases to interest rates in an effort to tackle rising inflation in Europe and the United States. Brent crude futures fell by 34 cents, or 0.36%, to $92.83 a barrel by 12:20 GMT. U.S. West Texas Intermediate crude was down 32 cents, or 0.37%, at $86.99. The European Central Bank's, ECB, chief economist, Philip Lane, on Wednesday repeated the bank's pledge to continue raising interest rates with its focus on inflation. Higher energy prices remain a dominant driving force of inflation in the Eurozone, Lane said.
Moving on to the top news in the energy sector.
The European Union's executive outlined plans on Wednesday for raising more than €140 billion, $140 billion, to cope with an energy crisis that has increased the prospect of winter fuel rationing, corporate insolvencies and economic recession. European gas prices have rocketed this year as Russia has reduced fuel exports to retaliate for Western sanctions over its invasion of Ukraine, leaving households struggling to pay energy bills and utilities grappling with a liquidity crunch. European governments have responded with measures ranging from capping prices on consumer electricity and gas bills to offering credit and guarantees to prevent power providers from collapsing under the weight of collateral demands.
China is buying more and less expensive energy supplies from Russia this year, reaping the benefits of a plunge in European purchases just when Beijing needs it most as the Ukraine crisis pushes Moscow in search of alternative markets. The growing cooperation, to be further deepened with Chinese President Xi Jinping's meeting with Russia's Vladimir Putin in Uzbekistan on Thursday, is a boon for both countries. China has gained access to cheaper energy while Russia is able to offset losses from the European Union and other allies scaling back on purchases of Russian exports due to sanctions over its invasion of Ukraine. Moscow calls it a special military operation.
Next, we have the top news in metal markets.
Chinese steel futures fell on Wednesday after hitting two-week highs in the previous session, dragging down the prices of steel-making ingredients including iron ore as global economic headwinds added to worries about demand for ferrous metals. Concerns over a rapid rise in steel production in recent weeks amid a fragile domestic demand recovery, and the prospect of intensified COVID-19 restrictions in China also weighed on the ferrous complex. The most traded January rebar contract on the Shanghai Futures Exchange ended daytime trade 1.3% lower at 3,741 yuan, $537.07, a ton, snapping a three-session rally.
Gold inched higher on Wednesday as the dollar pulled back, but gains were capped by expectations for an aggressive Federal Reserve approach to U.S. inflation, which rose unexpectedly last month. Spot gold was up 0.1% at $1,702.50 per ounce by 12:37 GMT, while U.S. gold futures eased 0.2% to $1,713.20. While weakness in dollar is helping raise gold off its lows, higher yields are likely to make it more difficult for prices to make any meaningful gains in the short term, said Michael Hewson, chief markets analyst at CMC Markets. We will now look at the top news in the agricultural sector. India's rice exports could fall by around a quarter this year as New Delhi's restrictions force buyers to switch to rival suppliers which are offering the grain at a cheaper price, trade and industry officials said. Late last week, the world's biggest exporter of the grain banned shipments of broken rice and imposed a 20% duty on exports of various other grades as the country tries to boost supplies and calm prices after below-average monsoon rainfall curtailed planting. The duty has made Indian rice expensive. Exports would drop by at least 5 million tons, B.V. Krishna Rao, president of the Rice Exporters Association, TRAE, told Reuters. That would leave exports this year at around 16.2 million tons.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.